1. Passive investing and panic. Basic definition. Passive investing is a strategy that aims to track the overall performance of the market over the long term, typically through instruments such as index funds or ETFs. In this approach, the focus is not on market timing, but on long-term returns. Panic, on the other hand, is a sudden fear response. When prices decline sharply, investors may act on emotional reflexes rather than making rational decisions. 2. When and how do panic moments occur? Even passive investors with a long-term mindset can experience moments of panic. This usually occurs when the market experiences a sudden drop, negative news becomes widespread, herd psychology is triggered, the desire to stop losses becomes dominant. For example, during the COVID-19 pandemic, when global stock markets fell sharply, many investors turned to panic selling. These sales were largely driven by psychological reactions among individual investors. 3. Behavioral finance reasons behind panic selling. 3.1 Loss aversion. People feel losses more intensely than equivalent gains. Therefore, during downturns, the tendency to sell in order to avoid further losses increases. 3.2 Regret aversion. An investor may panic with the thought, prices will fall further, and if I don't sell now, I'll lose even more. This psychological bias becomes especially strong during periods of uncertainty. 3.3 Framing effect. Investor behavior can change depending on how market news and price declines are presented. A negatively framed news environment can increase or decrease panic selling. 3.4 Herd behavior. Information that other investors are selling, amplified by social media, can trigger panic behavior. Thoughts like, everyone is selling, I should sell too, can quickly turn into panic. 4. The effects of panic moments on passive investors. Investors who panic often experience the following consequences. Selling earlier than planned. Deviating from long-term strategy. Missing potential recovery opportunities. Locking in realized losses in the portfolio. This is because decisions made during panic are usually emotional rather than rational. 5. Scientific and psychological explanation of panic moments. 5.1 Observations from behavioral finance. Panic selling increases when market uncertainty rises and investors' short-term emotional reactions dominate. When combined with loss aversion and fear of regret, these reactions can lead to irrational selling. 5.2 Demographic tendencies of investors. Research suggests that panic selling behavior is more common among investors with lower financial literacy and higher emotional sensitivity to fear. As education level and financial knowledge increase, the likelihood of panic selling tends to decrease. 6. Concrete market examples of panic moments. COVID-19 market crash, 2020. When global markets declined rapidly, many investors engaged in panic selling and missed the subsequent long-term recovery. This behavior was observed even among passive investors. Market volatility, 2022 to 2024. During periods of volatility in Turkey and global markets, a significant portion of investors sold their positions during sudden downturns, demonstrating how widespread panic behavior can be. 7. The damage of panic moments to passive investing. When sales occur near market bottoms, portfolio losses become permanent. Long-term opportunities are missed. The power of compounding is disrupted. Such decisions often cause investors to deviate from their passive investment strategy. 8. Protection from panic. Effective strategies. 8.1 Create a plan. Write down your investment goals, entry/exit rules, and risk tolerance. When emotions are triggered, returning to a written plan makes disciplined action easier. 8.2 Use automated systems. Automated investing methods such as systematic investment plans, SIP, or dollar cost averaging, DCA, reduce emotional decision-making and help prevent market timing mistakes. 8.3 Increase financial literacy. Education and knowledge reduce the likelihood of poor decisions during uncertain times. More informed investors are less likely to engage in panic selling. 8.4 Be aware of your emotions. Understanding investor psychology allows you to recognize panic impulses. When you identify fear and herd effects, you can develop a more strategic response. 9. Summary of panic moments for passive investors. Panic moments arise when emotional reactions override rational decision-making. Loss aversion and regret aversion are the primary triggers of this behavior. Panic selling negatively impacts long-term returns in a passive strategy. Knowledge, planning, and automation are key tools for avoiding panic. Conclusion. Even passive investors can experience moments of panic because market uncertainty naturally triggers emotional responses. However, understanding and measuring these reactions makes them manageable. To avoid panic, it is most effective to clearly define investment goals, use automated strategies, and improve financial education.